Hi viewers, good to have you here. Okay, you're welcome. Alright, if you're joining us for the first time or this is your first time of seeing us, you are in the right place. Okay, this is an online tutorial for undergraduates and senior secondary students. Okay, we also take academic mentorship here. Alright, so you're highly welcome. Alright, so quickly, we are going to be looking at bank reconciliation under financial accounting. Alright, now when we talk about bank reconciliation, now, I need you to understand that, okay, in the previous, in the introductory class, I mentioned that we can't be talking about bank reconciliation without the cash book. Now, for the 3-column cash book, where we have the discounts, the bank, and the cash, okay, the bank column of the cash book is what we are interested in here, the bank column. You know the cash, okay, what is going to happen? I'm going to share the link to the class we did on cash book. I'm going to share it in the description, okay, so that you can go through it and refresh your memory, okay. So I will not be able to go into all that now because of time. All right, and this may be the part 1 of this class. I doubt if we can be able to finish it today, to finish this class today. So this might be the part 1, okay, but let's see how far we can go. All right, so now when we talk about bank reconciliation, we're talking about making the bank column of the cash book and the bank statements to agree. We are trying to reconcile the bank statement and the cash book. Okay, there must have been factors that may have caused the differences between these two accounts, because all things being equal, the bank column of the cash book, the entries in the bank column of the cash book is supposed to be the same with the entries in the bank statement. Do you understand? If the cash book balance, for instance, if we have 500 as the cash book balance, we're supposed to have 500 in the bank statement. Remember, as a business owner, sometimes you take maybe cash or checks or payments to the bank. Businesses have bank accounts. Do you get it? For instance, ePlus Limited, if that's a business now, ePlus Limited. ePlus Limited must have an account with the bank, okay? Now, sometimes transactions that are being done in the office that has to do with checks, maybe it has to do with cash lodgement and the rest of it, it's supposed to appear on the bank statements. Sometimes, like for instance, if we have, if a customer pays in maybe a check into our bank account, okay, we are supposed to record it on the debit side of our cash book that transaction has entered, that we have received value for our services. So it's going to be recorded on the debit side of our cash book, then on the credit side of the bank statement. When money comes into the business, okay, it is debited on the cash book and credited in the bank account. When money goes out of the business, it is credited on the cash book and debited on the bank account. So if we have a favorable cash balance, okay, cash book balance, that is to say our payments is supposed to be less than our receipts. That is, our receipt is supposed to be higher than payments. So we are supposed to have a debit balance for cash book and have a credit balance for bank statements. That is a favorable cash business transaction over the period of time. But if there's an overdraft or there's a deficit, maybe our payment is higher than our receipt, okay, the cash book will have a credit balance while the bank statement will have a debit balance. Do you get the difference now? Okay, now, sometimes that may not be the case, because sometimes your receipts can be higher than your payments and your payments can be higher than your receipts. So you may not have one situation all the time. Do you get it? So sometimes it can be profits, sometimes it can be losses and all that. It happens, okay? But the fundamental thing here is that the balances must be maintained. If the receipt is greater than the payment, we'll have a debit balance in the cash book and a credit balance in the bank statement. But when the purchases or the payments are higher than the receipt, we'll have a credit balance in the cash book and a debit balance in the bank statement. okay, okay, let me use this typical analogy. When people send money into your bank account, so you get you do get credit alert. Yeah, that's simply what we're talking about. When money leave your bank account, you get a debit alert. So that's basically what we're talking about. So that is the same case for the cash book. For the cash book, when money goes out, it's credited. When money comes in, it's debited. So in a nutshell, what we are looking at here is the bank column of the cash book, not the cash column, because here we are dealing with bank reconciliation. So our interest has to do with the bank. So the bank column of the cash book versus the bank statement. That's what we're interested in here. So I need you to narrow your mind down to this concept. The bank column of the cash book versus the bank statement. Not the cash column, please. Okay? All right, now we're going to look at the factors that may have caused, because just like I mentioned, sometimes you have on the cash book, you have a balance of 500, for instance, while on the bank statement, you'll be having 480. Normally, you're supposed to have 500, 500. The cash book should be 500, the bank statement should be 500. But sometimes, there can be differences. That is where reconciliation comes in. But before reconciliation comes in, there must be factors, or there must have been factors that are responsible for these differences. And those factors, we are going to look at them now. Are we together? If you're not understanding me, kindly use the comment section so that I can throw more light on it. Are we together? All right, so we are going to look at those differentiating factors now. Number one, okay, let's look at factors that has to do with the cash book first. Factors that has to do with the cash book. Okay, we have number one, we have what we call unpresented check, unpresented checks. Okay, we have what we call uncredited checks. Okay, now unpresented checks, these are checks that have been issued out by the company or by the business. Okay, issued out by the business to customers or to suppliers, but those suppliers or those payees, they are yet to present it to the bank for payment. Meanwhile, in the cash book of the business, okay, let's use which business? Let's use ePlus Limited. So when I say business now, let's our mind. So when I say business, we are talking about ePlus Limited as an example, though. This is an example. So ePlus Limited must have issued checks, okay, to customers or to suppliers or to payees. So those payees or suppliers are yet to present that checks to the bank for payment to get value. But meanwhile, in the cash book of ePlus, they have credited it. They have recorded it on the credit side of their cash book. Their money has gone out. But the customers or the people who are supposed to receive value have not presented the check for payment. Do you get it? So in this case now, the cash book has been reduced by that amount. Meanwhile, the bank statement has not been reduced by that amount. Do you get it? And that's where uncredited. So this is one of the factors that may cause that differences. Okay. Now, uncredited check or lodgements, checks or lodgements, okay. Sorry, lodgements. Okay, it should be like lodgements. Okay. Yeah, I hope I got it rightly. Okay, lodgements. Okay. So where uncredited checks, these are lodgements that were supposed to be credited in the bank statements of the company. Okay, maybe checks. Some customers, they don't like maybe paying cash and all that, so they pay with their checks. Okay, so maybe but at the end of close of business, the company takes the check to the bank. Okay, so that money or that value can be credited to their bank account. Okay, but by the time they take that checks to the bank, they might have one delay or the other, clearing system and all that. So in the debit side of the cash book, okay, the debit side of the business cash book, they have recorded it that yes, money has come in. Okay, but those checks which are presented to the bank for value, okay, the bank has not credited their accounts with those amounts. And the major reason for this is the clearing system. Sometimes it takes 48 hours, sometimes 24 hours, due to maybe one reason or the other. So that's what we mean by what uncredited checks here. Okay, are we together? Please use the comment section if you are not getting me. So this is then on another aspect we have items, okay, or payments. Let's use payments in the bank, payments in the bank statements. Okay, now this unpresented check and uncredited check we highlighted now, it's for the cash book only. These are factors that has to do with the cash book, the differences, factors that causes the differences that has to do with the cash book only. Then let's look at payments from the bank statements now, the factors. We may have what we call interest on loan, okay? Interest on loans, bank charges, okay? Bank charges or commissions, okay? Then we may have what we call direct debits, okay? Then we have what we call standing order. Standing order. We have what we call the dishonored check, okay? Dishonored checks. Now, these factors is applicable to the bank statement only, not the cash book. This one it has nothing to do with the cash book. This difference is here, or these factors that causes the differences has to do with the bank. Why these factors that causes the differences has to do with the cash book. Are we together? Now, when we say interest on loans, what we mean by interest on loans. Maybe you take out a loan on the bank and maybe monthly the bank deducts some amount of money as interest from your account, okay? So by the time they deduct that money from your bank account, you may maybe forget to, treat the same in the cash book, okay? Maybe, let's say the interest is 5,000 monthly. By the time they debit you 5,000 from your bank statement, you might forget, okay, to credit your cash book with that same 5,000 as interest. Remember I said whatever happens in the bank statement must happen in the cash book. All things being equal. Whatever goes on there must still go on here, so that the both accounts must have the same balance. Do you understand? So that's what we mean by interest on loans. Then we have bank charges. Now for some of us, sometimes you just see alerts you just get an alert on your phone. ATM maintenance, ATM fee, all those small charges. That's what we are trying to talk about here. Those little charges you're being debited for. Those are bank charges or commissions, okay? Now they must have debited your account, meanwhile you have not credited your cash book with the same. Then direct debits, these are instructions, okay, given by the E-Plus or businesses, okay, to the bank to pay, to remove some certain amount of money from their accounts, okay, to pay some make some certain payments. Okay, a typical example is insurance premium. Okay, so E-Plus can just walk to their bank and say, okay, every month you'll be removing so amount of money from my account to pay my insurance premium. That's a direct debit. Okay, so the same thing with standing order. They can still, okay, E-Plus can still say, okay, walk up to their banker and say, okay, I'm giving you a standing order to pay out so amount of money for maybe hire purchase, or it can be for anything, subscription, it can be for anything, okay? It's a standing order. It's almost similar with the direct debit. Okay, so we have the dishonor check, okay? Dishonor check, sometimes when have you noticed that sometimes when a business or a customer receive value, okay, when a customer's account is being credited, okay, you will discover that they had to do maybe a reversal or something. Now this must be maybe due to one reason or the other. Okay, maybe something happened to the check, or maybe there's an error with the payment, or they're trying to pay a wrong customer, or one thing, okay? So when you have situations like that, the transaction is immediately reversed, okay? That's when dishonor checks come in, okay? That's when we have a situation of dishonor check. So at that instance, the account that was credited now is now debited. There is now a reversal on payment. Okay, the check is now dishonored due to one reason or the other. Are we together? So these are instances for the bank payment in the bank statement. Then we have receipts in bank statements only. Okay, in bank statements only. Okay, so one of them we have dividend. We have interest received on deposits. We have traders credits. Traders credits. Okay. Now, when we say receipts in bank statements only, these are factors, or these are transactions, or these are entries, okay, made by the bank. Okay, when the bank credits the customer's account with this transactions, okay, dividends, it has to do with shares, okay, your income from shares, okay. Then we have interest received on deposits, okay. Then we have the traders credit. Now, this payment or this receipt must have been credited in the bank statement of the company, okay, but the company is yet to debit it in their cash book. So that may cause a difference. Do you get it? So by the time the bank credits the business with these entries, the business on the other part maybe forgot to enter it in the cash book, on the debit side of the cash book, it may cause problems. It may cause differences. Do you understand it? So another instance, we can have what we call bank errors. Okay? Then we may have what we call the cash book errors. Okay? We have what we call the bank errors, the cash book errors. So these are factors that may cause the differences. Okay? The discrepancies from the cash book, with the cash book and the bank statement. Okay? Alright, so let's look at one more thing before we call it a day. Just like I told you, this can be, I think this should be the part 1, okay? When we finish, we're going to continue from when we stop in the other class, in the subsequent classes, okay? So let's look at one more thing before we call it a day. Okay, so the last thing we're going to look at is the method, or the method of preparation of the bank reconciliation statement. Okay, there are 2 basic methods. Okay, so maybe what is going to happen is we're going to stop here. I don't want the class to be too long. So in the next class, that will be the part 2. That's where we're going to continue from. Okay, we're going to look at the 2 methods of preparing the bank reconciliation statement. Are we together? All right, let me stop here for today. If you have any question, please use the comment section. Okay, thank you, and see you in the next class.